Warm welcome, everyone. My name is Marcus Henriksson. I'm an equity research analyst at ABG Sundal Collier. It's time for another round of Investor Days, 2 days where we get the opportunity to listen to a wider range of companies that we cover at ABG. First out is Eastnine, a property company focused in the Baltics and Poland. And with us we have Kęstutis Sasnauskas, the CEO of Eastnine. I will stop there and leave the word to you.
Thank you very much, and it's very nice to be the first, whilst everybody is still awake. So what is actually Eastnine, and why we consider it to be a very, very exciting opportunity? Eastnine is a listed company in the Swedish Stock Exchange, Stockholm, Nasdaq, but it has all of its properties on the eastern side of the Baltic Sea and the southern part of the Baltic Sea now. And we focus merely on offices. But what is the actual case about us? And the case is probably very easily summarized in this graph. You see the yields. The yields are significantly higher in our part of the world, but they come with a combination of three very, very exciting factors. One is that the underlying businesses, most of the underlying businesses that inhabit modern offices is actually multinational. So it's an international companies as they are in Stockholm. They also, we also finance ourselves mainly with the Nordic banks, which means that our conditions are relatively similar. And the rent levels, of course, are significantly lower. So combination of higher yields, low rents, same financing conditions makes us as a real estate company quite compelling, and the story of real estate as such very compelling, especially in the light of ongoing convergence and growth in the underlying markets. If we go to our first quarter results, we actually had record results during this first quarter. Our sales are up 45%, but we are mostly proud, of course, is the profit from property management that is growing by 70%. So almost twice the speed of our turnover. And here we see very, very clearly the scale effects of adding new modern properties in our portfolio. Even on like-for-like basis, and even have been affected by the increased interest rates, our actually profit from property management is growing 26% compared to Q4 last year. And this is, of course, driven mainly by larger portfolio, of course, only in comparison for Q1. But we also perform better on all parameters: occupancy, rent levels, and of course, there is some negative in terms of value change of properties, but this is mainly driven by the increased yield requirement in the Baltic market. And our properties are valued approximately 30 bips up compared to Q4. We are ongoing discussions in MFG. We can come back to that a bit later. So if you look on basically the macro situation, the Baltic markets and Polish markets have been developing faster compared to the Northern Europe, faster compared to EU average in general. We had a smaller dip in our markets compared to EU average during the pandemic, faster recovery. But if you look basically on any single timeline, the Baltics and especially Polish market have been growing faster over time, since basically the collapse of the Soviet Union. The convergence have been taking place and the economic activity has been growing. We have very high inflation in our markets. We have very little tools in the Baltics to manage the inflation because of the countries are in Eurozone and basically do not have any significant tools other than taxes, which are quite unpopular to do. But Poland has its own currency, its own central bank, so they have been able to manage it a bit better. Strong employment figures. We actually see the record high discrepancy, at least last year, we've seen between the sort of job vacancies. Still have very, very high job vacancies and some of the higher unemployment in the Baltics compared to Poland. Poland has always had very low unemployment rate. The other important factor I've talked about is actually the rent levels. So the rents have been quite steady over the time, but now started picking up in Vilnius. It's the first quarter we see actually a significant increase in Vilnius rents. And this is mainly driven by partially inflation adjustments, but also increased construction costs. So basically all the new stock is coming at a significantly higher price. We now see no clear trend in vacancies. You could see that, okay, vacancies are pretty high, but at the same time, we see a very, very big discrepancy today in vacancy between better located properties, which are almost full, and worse located properties that are becoming more and more empty. So the worse quality you have, the more difficult it is to lease out, and the more difficult it is actually to bring people into those offices. So for us, having a very modern stock, we're actually experiencing record low vacancies. You can see in our figures that actually our vacancy is merely 3%. The yields on the rise, of course, they have been compressing over time, as all the markets, but the Baltic yields have always been around 200-300 bips above the Nordics, and Polish, probably if you look for regional cities, is 300-400 bips above the Nordics. So where are our properties? You can see basically where Stockholm is, Helsinki, and our plan is to build a portfolio on the eastern flank of the Baltic Sea, with Vilnius being our biggest hub today. Around 67% of all property value is there, then followed by Poznan and Riga. But actually this yellow line is the planned, or is being constructed at the moment, is the Trans-Baltic Railway, which will increase the infrastructural integration of the Baltics with the Western Europe. And we want to be along this line. And it's no strange why we have Poznan property there as well. Poznan is actually closer to Berlin than it's to Warsaw. And it's a very exciting region, as we see. So you can expect us doing deals in basically all of this eastern flank. Today we have 14 properties, 183,000 square meters of space, and approximately 600 million euros in property value. Distributed by different types of tenants: ICT, finance, e-com. We take questions at the end if it's okay. And then we have retail and other services. Approximately 25% of our contracts will expire within the next 2 years, but it doesn't mean that they will be vacated. It means that they will be just renegotiated, most of them. If you look on our sustainability work, 94% of our floor space is environmentally certified today, and it's also environmentally certified in the highest brackets, LEED Platinum or BREEAM Outstanding. Green leases constitute approximately 68% of our portfolio, and what I'm mostly proud of actually that we consider 91% of our revenue today EU taxonomy compliant, which is a very big thing. In GRESB, we ranked 92 points, very close to the top Swedish peers. In Allbright, we are 6th place out of 355 listed companies, and Great Place to Work we rate very high. It means that we have very motivated, very strong team and reliable team to bring this company even further. So basically going back a little bit to our quarterly figures and our development lately, occupancy rate is reaching almost 97% during the quarter, 6 percentage points compared to Q1 last year, 0.3 points compared to Q4. So we continue on a strong lease out, and this is especially important given the sort of the worries about the office future and so on. You see that actually post-pandemic we actually continue lease out and continue see strong demand for our properties. Average rent level increased 6% compared to Q1 last year and 5.2% compared to Q4. Surplus ratio, överskottsgrad, is up to 93%, which is very, very high compared to Swedish standards. This is mainly driven by triple net leases and means that actually the cost inflation doesn't hit us as much as long as we have properties leased out, because most of the cost is actually moved to the tenants. And it also increased 5 percentage points just because of the higher lease out ratio. Value of property portfolio decreased somewhat, but still up compared to last year. So if you look at our financials, as mentioned before, rental income grows 45%, which is really high. But again, profit from property management up 70%, which makes our results best ever operationally. And if you look on our earnings capacity, which is probably the most important figure that we want to show, especially with this very fast-growing portfolio, is actually now compared to last year, year-end figures, we expect to grow approximately 6% in revenue and 8% in profit from property management. So you see the sort of still there is a scale effect, even though there is no new additional properties in this kind of estimate at the moment. Doesn't mean that we will not buy, just doesn't look. It's a picture, shows you, basically this picture shows you the situation as if nothing would happen, basically, as it is today. If you look on valuations, a 30 bp increase in the yield rate resulted in a decrease of property value. But other than that, I mean, we had a certain increases. We've been quite conservative on increasing the values overall. Well, everybody is in this today. If you look on the financing structure, the interest rate is around 3.8%, so it's growing. And net LTV 52. ICR increased mainly as a result of indexation and higher average rent level. Loan maturity is 2.1 and average interest maturity is 1.7. Approximately 1/3 of our loans are actually unhedged. The rest is fixed interest. So why Eastnine? You can see we are actually a growing company coming from a relatively low level, so we can continue growing quite fast for some time and build up our portfolio. We actually, once we built our portfolio, we also increased the profit from property management, and we see very, very big scale effects actually of adding new properties. Because as we have already the full-scale organization, adding new modern property with triple net leases basically trickles down to the bottom line. So the bottom line should be growing much faster than the top line. Long-term equity grew from 116 just 5 years ago to 241, and dividends per share also increased. So basically on this, I open up for questions.
Perfect, thank you. I guess we could maybe start with the floor if we had any question there initially.
What's the timeline regarding the railway?
And I will also update it so we get it on screen. So what is the timeline for the railway in the
For the railway.
Baltic?
There are some delays in it. I think 2030 was the sort of original plan to have it up and running. Now we hear from here and there that some of those are delayed for some years, but we'll see. I think some parts will probably start functioning by 2030. But there is interconnection between the three countries, and three countries build their own, so to speak, network. So, but we still hope that it will happen.
Thank you. I will start off. You seem quite confident that you will do some M&A, some acquisitions. As we saw there are a few cities that you're currently not have any presence in. You also have a target to reach property value of 700 million euro. You're at 590, as you show here, by the end of Q1. How should we look at this target in terms of current cash flow, potential divestments? that
Well, I
free up
mean,
cash flow?
the biggest game changer for us, of course, is our exit in Melon, which we are working on. And should that happen quite soon, then we have all the potential actually to increase our property portfolio by almost 400 to 500 million euros additionally, and relatively quickly, because the market has changed. Now it's the buyer's market rather than sort of the seller's market. So we see much more offerings in the market, and they're becoming more and more attractive. So we definitely see a potential there, but it depends very much on Melon. Should Melon not happen, probably that target will not be reached this year, and we will need to sit down and think, how do we grow further and how do we develop further.
Makes sense. Then I note that you have a bond maturing in July 24. We've seen several companies in the sector that my view is that the banks are quite supportive with current existing debt, but they are not keen to roll in maturing bonds into bank debt. What's your take on your refinancing with MFG as a divestment and without MFG as a divestment?
Yeah, I mean, if MFG happens, then it's pretty easy and pretty clear. I think if MFG doesn't happen, we are looking at various alternatives. And of course, we have the same alternatives that any real estate company. Maybe increase some of the financing. Of course, there is possibility maybe that the bond market will open up and rolling would be possible. Depends a little bit on the cost of it. But if that doesn't happen, we also prepare liquidity to be able to basically refinance it from own funds.
Are you able to increase more into bank debt, or are you quite
There is a
high
possibility because in general, we amortize quite a lot. So there is a possibility partially to increase the debt. There's also a possibility to, do any divestments at the same time. So I mean, there's plenty of opportunities.
As we saw by the presentation, you have very strong operational performance. It's a bit divergence versus other companies in the sector, even though it's different sub-markets and different countries. But you are performing very high level. Now, what could you still improve, or should we view it as there is more risk that occupancy could decrease from here?
Well, I think the occupancy will probably always move up and down a little bit. I think we're working quite hard. We still have a possibility to increase the occupancy, and we still see a relatively strong demand on the premises as such. The general trend probably is that people are decreasing somewhat of their space. But if you look at most of our clients, actually they are recruiting. So if you look on basically any kind of internet site for recruitment, you would probably recognize most of our tenants on those sites. So they're still employing quite actively. They're probably not increasing more space per se, so they're trying to be more efficient, as most of the companies. But what we see is very, very clear trend, as I mentioned before, that there's a very big move towards higher quality premises, even if they are smaller, but you want to offer other services, better location, better, more attractive building, and so on and so on. So from that perspective, we see basically the same trend all across the Nordics as well. We see in Stockholm still signing, people signing still record leases. In the central locations, while in the suburbs you probably see higher vacancies. And that's exactly the same situation as we see in the Baltics.
And what would you say are the catalysts? Why do we see that change, that we see a big discrepancy between secondary location and prime location here in say, late 22 into 23?
Well, it's I think flight for quality. The office, you need to offer something more today for employees to come back. Of course, you can say that, we have much easier commute in the Baltics. In general, we probably have not as good living standards, so it's more, it's nicer to go to the nice office than to work from home. People live a bit in a smaller space in general, and compared to the Nordics. But overall, and we see a lot of companies actually hiring and growing. And of course, when you grow, it's very important to build your culture. And the easiest way today to build your culture is actually to have people in the office come in and actually transfer the knowledge and so on and so on. So from that perspective, we believe that demand will stay. The exposure in the sectors for us is very much IT, banking, and e-com. And all of those have been performing extremely well over this period. We see some slowdown in sort of industrial production and so on as a result of the overall economic slowdown in Western Europe and slowing demand. But for the IT services, we see still a very, very strong demand for programming and so on.
Last question for someone that's not so familiar about the Baltics listening in. You mentioned the higher property yields, and you mentioned that you can work with the Nordic banks, and that GDP growth has historically been higher post the Soviet collapse. But could you mention any other like cultural difference, why it's more interesting to be in a property market in the Baltics, or
being Lithuanian is very difficult to say very big cultural difference. I mean, of course there are cultural differences, and all three Baltic countries are different, and Poland is different in some respects. But in general, I think what we see is the sort of very long-term convergence trend that has been going on, and it's now probably even accelerating more and more with the higher integration. Of course, the region has been affected by the war. The effect, everything that comes that's horrible with the war has also there is kind of on the property side has been kind of more positive because there's more demand for apartments. There's more demand for living space, but there's also pushed the demand for properties as well, office properties, because we see a number of clients moving from Belarus, moving from Ukraine, partially part of the operations to this region, so from that perspective, it wasn't so negative for us, but perception, of course, affects the valuations and probably the investor interest as well. But in general, I mean, underlying business is doing very well. But I think the long-term convergence is the key story. And especially now when we are in the world where probably there will be more nearshoring of services, more nearshoring of production, where Poland has a very, very strong base and very high potential for that. We'll probably see continuously strong demand and continuously strong growth in that market.
Very interesting. Thank you for that, and thank you for listening in. We will be back shortly with the next company. Thank you.